Realty Income, and Vici Properties. It was an incredible sell-off. In fact, it was the worst percentage sell-off we have seen for NVIDIA specifically since March of 2020. Is the AI bubble bursting? Is this an AI reset, or is this simply an overreaction? Well, in today's video, we're going to be taking a look at 5 stocks that are worthy of a buy here in February 2025. I often like to say red days are when long-term wealth is really made. So before we begin and unveil these 5 stocks, do me a huge favor. Simply click that like button down below, show your appreciation, as well as subscribe to the channel. And with that being said, let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors. Taking a look at 5 stocks I'm looking to buy here in February. Beginning with stock number 1, which is going to be Meta Platforms, stock ticker META. Over the weekend, when the news of DeepSeek came out, the first stock that I thought about was going to be Meta Platforms. This is a company that has been spending billions towards AI and VR. In fact, over the past few years, they've been spending over $30 billion. Imagine them finding out, knowing that they can do all of this, but do it cheaper. That's going to be money that's going to go right into margins, right to the bottom line, and could have a substantial impact on the likes of Meta Platforms, stock ticker META. Over the weekend, when the news of DeepSeek came out, the first stock that I thought about was going to be Meta Platforms. This is a company that has been spending billions towards AI and VR. In fact, over the past few years, they've been spending over $30 billion. Imagine them finding out, knowing that they can do all of this, but do it cheaper. That's going to be money that's going to go right into margins, right to the bottom line, and could have a substantial impact on the likes of Meta. There's a lot of ifs though. There's a lot of unknowns when it comes to this DeepSeek in terms of how much did they really spend and how useful is it going to be moving forward. So the one thing that we do know is that it's going to be a benefit to Meta Platforms. The company currently has a market cap of $1.7 trillion, making it one of the largest companies here in the U.S. And over the past 12 months, shares are up 65%. But since the start of 2023, we've really seen this major bull market. Shares of Meta are up an impressive 450%. One of the few stocks that can even rival that of NVIDIA. They still aren't that close over that time span. For me, when I'm researching stocks, whether it's growth stocks or dividend stocks, one of the key metrics that I hone on is going to be what's called free cash flow. Because I often like to say companies can't grow without free cash flow. Here's a look at the company's free cash flow over the past few years. In 2022, Meta generated $13.4 billion in free cash flow. 2023, $40 billion. And over the trailing 12 months, they were up to $52 billion. Not only are they investing a ton, but growing their free cash flow at the same time, However, I should warn you that Meta earnings are coming out very soon, so it may be best to digest those first before investing, because we may get a better entry point. And that leads us to stock number 2, which is going to be AbbVie, stock ticker ABBV. AbbVie is one of the longest held positions within my portfolio. For years, I've had many stocks come and go, but one of the longest tenets has been AbbVie, something I don't expect to change for years to come. The company currently has a market cap of $313 billion, and over the past 12 months, shares are up just 8%. AbbVie was in fact a spin-off from Abbott Labs, but lo and behold, 10 plus years later, here we are with AbbVie being even larger by roughly $100 billion. AbbVie has had a great run. After all, they had the #1 selling drug in the world for a number of years in Humira. But, as many of you know, they lost patent protection a few years back. But that has evolved the company into much more of a diversified company. They have Skyrizi and Rinvoq, 2 blockbuster drugs that are expected to be even larger than that of Humira when combined. And on top of that, they also have a loaded pipeline. AbbVie has also been what I like to call an investor's trifecta. They've offered great share price appreciation, a solid dividend yield, and strong dividend growth. Speaking of that dividend, the yield currently sits at 4%. They have a 5-year dividend growth rate of 7.5%, something I expect to return to that double-digit range moving forward. And they have grown their dividend every single year for 11 straight years. In terms of valuation, analysts are looking for the company to generate EPS of $12.08 this year, which gives them a forward PE multiple of 14.6 times. This is slightly above their 5-year average of 12.1. So when we compare to the 5-year average, again, shares don't look cheap, very similar to what we just saw with Meta. But AbbVie continues to evolve, growing its free cash flow, find ways to be more efficient, and grow its pipeline. It's the same steps that large biotech companies have taken over the years. Think of the large ones like Merck, as well as Amgen, both of them trading with an average 5-year multiple of 15 times. So they have expanded that, which is where I believe AbbVie is headed. So in terms of the area and the target I'm looking to add to my share count, that's going to be around $160 per share or less. And again, AbbVie reports at the end of this week, so let's wait and see how those results come in. And that leads us to stock number 3, which is going to be Merck, stock ticker MRK. We just spoke about AbbVie a second ago, where we mentioned Merck. Well, now we get to talk a little bit more about it. What we saw with AbbVie was a much smoother ride. Shares up 8%, stocks doing all right. However, shareholders of Merck haven't really enjoyed that. It's been more of a wild ride. The company currently has a market cap of $248 billion, and over the past 12 months, shares are down 20%. So what is going on with Merck? What is not to like? After all, the company has a superb balance sheet. It continues to show their ability to develop their pipeline. They have one of the top selling drugs in the world in Keytruda. What's not to like? Well, there have been concerns about slowing growth in Keytruda, as well as the upcoming patent expiration for Keytruda as well. So they really need that development in that pipeline to speed up a little bit. But for those of you well in tune with the healthcare and in particular biotech sector, or industry I should say, you know that these companies go through cycles, and I believe that Merck is just starting its next growth cycle. Like AbbVie, Merck too has been a strong dividend-paying option, as they currently have a dividend yield of 3.4%, a 5-year dividend growth rate of 7.6%, consider subscribing to my newsletter, The Stock Investor's Edge. Check out the link down in the description below. One of the things I like most about Eli Lilly, obviously their revenues are growing at a very fast pace, but at the same time, this is a company that is continuing to look for ways to improve. One of those areas has been through efficiency. This is a company that is operating with gross margins in excess of 80%. Here's a look at their EBITDA margins the past few years. In 2022, they were at 30.1%. 2023, they dropped to 24.6%, but over the trailing 12 months, they were at a high of 30.2% over that 3-year time span. Although Lilly pays a dividend, they're not really known for their dividend because it's so small, but it does grow at a fast pace. The yield currently sits right below 1%, but they have a 5-year dividend growth rate of 15%, and they have grown that dividend for 10 consecutive years and counting. In terms of valuation, analysts are looking for the company to generate 2025 EPS of $22.67 per share, which equates to a forward PE multiple of 35.6 times. This below their 5-year average of 40.2 times. That's a hefty premium to pay. 35 times stock. You better hope for a lot of growth. And with this company moving forward over the next few years, that's exactly what they're expected to do. In 2025 alone, analysts expect 74% earnings growth. The year after that, analysts are looking for another 30% of earnings growth. If you put those two together in average amount, utilizing that PE multiple that we just looked at, this is a company that is trading with a PEG ratio of just 0.7. Now that is rather intriguing. In terms of my buy price target, I'm looking to buy shares again around that 750 level or below, as that's exactly where I recently nibbled and would like to buy more. And that leads us to stock number 5, which is going to be Stag Industrial, stock ticker STAG. Now we're moving on to the REIT sector, a sector that's near and dear to my heart. And again, for those of you that watch my weekly live show or you're a subscriber to the Stock Investor's Edge, one area that I've been big on heading into this year and even in last year was industrial stocks. Why? Because I'm a believer in the growth in e-commerce. And what is my favorite REIT in this sector? It's going to be PLD, a stock that I've talked about for the past few months. And if you date back to December 19th until today, as of this video, shares of PLD have climbed 20%. We're talking about just 5 weeks ago. So, although I still love PLD, one of my largest REITs within my portfolio, I'm looking at other areas of value. Not selling out of PLD, but giving you another idea that's even cheaper and hasn't run up yet. And that's going to be Stag Industrial. The REIT currently has a market cap of $6 billion, so the smallest company on our list today. And over the past 12 months, shares are down 9%. When it comes to e-commerce, roughly 20% of all retail sales come from e-commerce. However, over the next 5 years, that number is expected to grow to over 25%. The penetration is going to be further and further. So, who does that benefit? It's going to benefit the companies that are in e-commerce. As those companies benefit, they need more storage space, more inventory. Who does that benefit? Companies like PLD and Stag Industrial. It's a trickle-down effect. Stag also pays a juicy monthly dividend that currently yields 4.3%. But although you get a juicy
that's what you have representing the place.
that 5-year dividend growth